The Hedgeless Horseman here. It's July the 26th, 2023. I just came back from a site visit tour up in Yukon. Visited quite a bit of companies. Well, let's start off with some Copium, because I've seen some whining today, and it's human. I understand it. It's like yesterday or the last few days. I mean, market has been kind of boring, I would say. Well, actually, the metals have been doing quite well, but there's been no real big buying interest in many of the juniors that I could see. Well, a few were up, I guess, yesterday. Still, that's the thing with excuse me. That's the thing with bear markets, or corrections. I mean, we've been in a. I mean, I already think it's over, but we've been in a, let's say, a bad period for the last 3 years. Right here we have a tweet by Willie Middlecoop. Small ASX miners have given back all gains from the 2020 bull. Yeah, and we're in 2023. Technically, they seem ready to break out and run again. That's just how this, well, every market works, especially a volatile sector. It goes too high and then it goes too low. And what everyone forgets is that nothing lasts forever. So now people are, with every increasing day that nothing happens, every additional day that nothing happens, or the units go down, and you get more and more, quote, evidence why you can't make money in a sector, in a cyclical sector, more people will sell. Because they're going to be starting to talk about, like they always do, like, oh, I should have been in whatever. S&P, I saw someone write about that, oh, I should have been in the S&P for the last 2 years because I've lost money in the junior sectors. That is absolutely worthless information. We can't invest backwards, but people will start to think like that, and then they, talk about opportunity cost. But obviously people tend to use opportunity cost. They just look at what happened, and then they form an opinion of what the opportunity cost was. Opportunity cost is not a period of time. You can't just look back and, I should have been in this or that. No, the opportunity is instantaneous. It's either there's right now, for example, S&P is trading at whatever multiple. You could say it's overvalued. Let's say gold juniors, I think they're extremely undervalued, especially the quality ones. So to me, the opportunity cost is extremely high to be buying S&P over gold juniors. I think that's, in my opinion, it's a no-brainer. I would rather be in gold juniors than S&P, simply because the opportunity is bigger at this very moment, in my opinion. But if we fast forward 3-4 months and S&P has gone up, become more overvalued, and juniors, let's say, have become more undervalued, then people will say, well, it was a high opportunity cost to be in juniors because they underperformed S&P. That's not opportunity cost. That's just looking at performance. It makes no sense. How does that help you? What do you do with that information? S&P did better. How can you have any help from that? Will it form your future decisions because you've seen the outperformance of S&P? Should you then, when miners are even cheaper and S&P is even more expensive, but you look in hindsight and see what happens, so what? Are you gonna buy an even more overvalued S&P and sell an even more undervalued gold juniors? That sounds like a pretty dumb thing to do. So why what do you do with that information? You just look at what happened. No, it's absolutely worthless information. That's not what opportunity cost is. That's hindsight investing. I should have done that or whatever. It's like, well, that's worthless information because we cannot know what's going to happen in the future. We can just try to see what we think is the best opportunity. And opportunity doesn't mean that a guaranteed win. It's like, I don't know when the junior sector is gonna come alive for real. I just know that when it does, it's gonna blow away S&P 500. And one should be willing to wait quite a while for that to happen. It's like, people expect 50% returns every month. That's why we tend to look at the tickers every day. While it makes absolutely no sense, because even the most violent bull rallies in the cyclical sector, like the junior sector, the 2016 rally, which was the most epic rally, I think, in quarterly rally or something. First quarter of 2016, but the actual bull leg lasted for 8 months. 8 months, and that was one of the most violent and quickest bull runs in the history of miners. That's still 8 months. Why do we, why do we care so much what a sector does on any given day? It makes little sense, but that's how it is. And people who do not outperform the market, they do a lot of daily ticker watching. Anyway, and that's like, I was away in Yukon. I don't think I did a single trade for a week, and it was lovely. I just checked, when I had internet reception, I just checked if there was, some news, etc. It was like everything I own is undervalued, so it doesn't matter. In fact, I'm gonna try to travel even more. Because I know no single bear leg lasts forever. No crash has lasted forever, and obviously no bull run has lasted forever either. But that's what people forget. The longer a leg persists, why would you sell here? This is a much worse sell than here. But that's when people convince themselves. They look in hindsight. I should have been in S&P 500. And then they, the lesson they learn is that, oh, right, because, excuse me, because I should have been in S&P 500 from here to here. Oh, the lesson I learned is that I should always be in S&P 500. So they sell here. If you sell the bottoms, it's like nothing is gonna help you. It's like I can afford to buy high, I cannot afford to sell low. And obviously, if you would just have made a simple, machine trading system here, it's like every time this sector goes down 50%, let's say, wherever that is, and you'll just buy every day, you're gonna make money. Start buying here, make money. Start buying here, buy all the way down, make money. Start buying here, buy all the way down, make a lot of money. Start buying, here or something, buy all the way down, make a lot of money. Start buying here all the way down, make it. Obviously you will have to do some stock picking, because over this 100-year period, very few mining companies are actually still around. But it's like my point is that a cyclical sector always comes back. There's always a big rally after a big crash, and there's always a big crash after a big rally. This rally here, big rally. This is what, I don't know, more than 50%. This is more than 50% down. This is way more than 50% down. Way more than 50% down. But if you just kept buying the crashes, you made money every single time. So it's like, that's my point when I've said before. It's like, I have no idea how I'm expected to lose over the long term in this sector. Because I just know that simple truth. And the trick is not to get fooled. The trick is not to be... how to say it, I was going to say, get exhausted, or to not let the market get you to sell low. I mean, there are some. I think some juniors are. What they've already had a bottom. They bottomed in 2022. I don't see them getting back to their lows. Is it possible? Of course. Let's say we have a market crash. We saw in the flash crash of 2020? Yeah, the COVID flash crash. They went down 50-60% in a month or so. But like a month later, they were back to even. So how big of a, how big of a problem was that? If you were asleep for like one to 2 months, you wouldn't see a change in your portfolio. So it's not really, that's the thing with like, people see that as risk. That's why, you see it all the time. Oh, well, if a market crash happens, I shouldn't be in miners. It's going to take everything down. What does that mean? Let's say you own the cheapest, you have a portfolio of 20 stock, they're dirt cheap, they should be up 200%. Why on earth would I not buy that? Because I had a chronic fear that if the market crashes, I might see it at a bigger loss for a while, for a week, a month. Well, there's always a risk for a market crash. Risk, in my opinion, is not, the risk of something going down in price. That's chronic. That's with us all the time. The market might crash at any given time. So if I had that mentality, which it seems a lot of people do, that I will not buy anything if I can't guarantee it will never go down in price. How on earth are you gonna, you can never be invested in that case, because that chance or risk is always with us. No, risk is something that you overpaid for, should go down and should stay down. If I pay 20 cents on the dollar for a company, so what if it goes down to 10 cents on the dollar before it goes up to $1? I make a ton of money from 20 cents even with a 50% drop first. But that's the thing. It's like people forget that. They look at the tree. Oh, I can never sit on a paper loss. I have huge paper losses all the time. Well, every other year, pretty much, I have 50% corrections, and I'm fully invested all the time. But it's the stupid shit we do. It just makes no sense. Really, it's like everybody has paper losses. The trick is to maximize the long-term results for the entire portfolio. I don't know if I can make it much clearer than that, but that's also, one thing I think is relevant, or that keeps me sane. It's like aim big, miss big. I don't like to be in quote opportunities where it's like, oh, I think this is 30% undervalued, or I think that the news flow could make this company go up 30% in value. That's not a good margin of safety, or that's not a big value range. Take Condor for example. If when they get to drill, Pucamayo, which I expect to happen soon. Does it really matter what price? Given how good the target looks, does it really matter if I paid 50 or 37 cents? In a micro time frame, it's gonna, obviously swing a lot. It's like I was away for a week and it fell like 43%. That's a huge drop, but does it matter? Pucamayo, in my opinion, could be like a massive deposit. If it is good as it looks and they drill that and confirms that over the next 6 months, if it is as good as it looks, it could be trading at multiple dollars. So does it really matter that much? No. Do I need to have the perfect price? Do I need to enter? Do I need to enter here? Do I need to pick the exact bottom? No, if if the case is that, well, if it looks as good as it is, or if it is as good as it looks, it's like, yeah, maybe, you know, success case it will be, I don't know, it's like, I think actually higher than this, but anyway. No, if it's a success, you know, you're gonna make a lot of money wherever you bought here. And in the meantime, you know, paper losses, let's say it goes down 43%, let's say you bought the top here, goes down 44%, you're like, you know, F me. Then it goes up 500%, or from here it goes up 237%, whatever. You would still make, you know, obviously you would make more from here, but it's like, hey, you know, I wouldn't be complaining if I get, you know, 237% in 6 months. I mean, I think the blue sky is a lot higher, but anyway, so it's like aim big, miss big. I don't like, I mean, if it was, you know, oh, if it's successful, you know, you'll get 24% from this point. That's not a big margin of safety at all. It's like, obviously, as we've seen, it can retrace 44% in a week. It can go up 77% in a week or two. Same with Magna. It's like, I mean, if you listen to management like Jason Jessup, you know, I'm not going to sell until we get to $1 billion. They want to be a mid-tier producer. That's a big aim. Now we even, you know, it's obviously very volatile on a short-term basis here. I mean, even the story has been getting better. I guess the nickel price has taken a beating. Still, I mean, it just got cheaper and cheaper without nothing getting worse. Here, for example, then poof, revaluation. So when you hear that, it's like, yeah, over the next, you know, 3 years they want to be a mid-tier producer, let's say. I mean, that's potentially a $1 billion company, or you know, more. That's a very big aim. Here we might be swinging, you know, 10-20 million dollars in market cap. That's nothing relative to the longer term end game scenario. So like, I have no idea when I did not expect Magna to go from here to here. It made absolutely no sense. And this recent flush in Condor probably didn't make any sense, but that's how the markets function. Somebody starts selling, people panic. Somebody starts buying, people get FOMO. That's how it works. Short-term horizon, I have no idea when I'm gonna make money or lose money on paper in the short term. That's just markets. That's not risk. That's just, you know, how these markets function. But if we fast forward, if my case is, well, from these levels, around these levels, if I come back in 1-2 years and management has been executing the way they have, the value should be substantially higher. And that's going to make this look cheap. This is going to look cheap, and this is going to look cheap. It doesn't really matter. So that's the case. That we're talking a good margin of safety there. For it's like, I'm buying now I'm paying X for this company, and I'm front running the company. You know, well, I'm buying Magna today for what I think it will be in 1-2 years. And you would preferably want the future value to be, you know, your base case of future value to be substantially higher than price today. Then, I mean, if the base case is that, well, Magna will be trading, you know, 500% higher, or Magna's value will be 500% higher than price today, that's a payoff that needs less than 50% chance of success. Because you would get, you know, 6 times your money. If there's even 50% chance, in your opinion, that that's going to happen, then it's a no-brainer. Absolute no-brainer. And Snowline, just look at Snowline, one of the best success cases. I don't know, you probably remember how much bitching it was around here. Well, throughout a lot of this period. So on a short time frame, it's like not too much actually changed. But you could have bought here, and a year later you would quote only be up 39%, which is actually really, really good. But in the meantime, you would suffer through a 60% correction. My case was simple for when I made a video, I think it was around 60 cents back. I thought that the runway for growth for Snowline was one of the biggest runways of any junior. But it takes time to prove that. It took news to happen. This trend here since 2021 materialized because there were positive news over the a 2-year period. There's a bunch of juniors out there which I think they're cheap based relative to what I think the value will be in the future after 20-30 news releases. But those 20-30 news releases, that the time required for that to happen has to happen before this looks cheap. So it makes no sense. I mean, if I sit there, I think this is really cheap, this growth story, I think it's going to be really cheap, look really cheap today, a year from now. And you're watching the ticker every day. It's like there's been no news out. The case is to wait like 1-2 years from today. If you're right, if your base case is right, maybe it will be up to 300%. But that's going to take 1 to 2 years to play out. It's not like, well, it can happen, but I mean, typically it's not like, even if, I mean, I think there are a lot of growth stories out there, which I think are like probably 200-300% undervalued relative to my base case of what they will be, even with a low chance of success. But I don't expect the market to just figure that out. It's like, whoa, okay, suddenly I realized that we're pricing in too low a chance that it will be successful. So without any news, it's just going to revalue. No, it might take 5 news releases for the first, let's say 50% pop or 100% pop. And if those news releases are good, like in Snowline, okay, success, feeds success, like the Kennerland study. Good early results signal that we might, what a news release says about the next 5 to 10 news releases. The early holes into Valley suggest that this might be a robust system. And lo and behold, the next, 20 holes were really good on average. And you had a growth curve like this. So let's look at some of the recent news. We have Clayule drill program at Clayule copper gold project to be increased from 7,000 meters to 9,000 meters. I did an article on Pacific Ridge recently. I think it's super cheap. I think it's pricing in too low a chance of Clayule being significant deposit. Fires prevented us from drilling Chuchi, reallocating the Chuchi budget for an expanded drill program at Clayule. I mean, if they slap on 2,000 meter at Clayule, it's like, with some luck here, maybe after this upcoming drill season, it might be clear that, hey, Clayule is, that's one of the better undeveloped deposits in BC for a, copper gold porphyry wise. And I think the market cap is 28.7. I mean, that's not pricing in a solid gold copper porphyry deposit in a tier 1 jurisdiction, obviously. And they have, you know, more projects to boot. They have like 5 projects in total. And they have, well, now they're gonna burn cash, but right now they have cash. He's pricing in 10% of a $288 million deposit. And 288 wouldn't even be a really good porphyry deposit. So I mean, if the chance of success of them finding or Clayule alone becoming something substantial, I mean, then it's even cheap now. That you know, that's the high risk, high reward shotgun approach. It's like, I'm not betting the farm on. Wait, I'm just gonna close the window. I'm not betting the farm on Pacific Ridge, but small holding of Pacific Ridge. I mean, if this turns out to be a significant gold copper porphyry discovery, then this is just going to look very cheap, and I think it could go up hundreds of %. In that case, that position is going to pay for a lot of other positions that get cut in half. So that's the thing, and you typically see, it's like, let's say someone is bullish on Pacific Ridge. Okay, I think it's cheap, like I do. Let's say Clayule ends up like a big failure. Then people will say, oh, he was bullish on that stock, you know, what an idiot. He said he was bullish. It's like, being bullish, if I think something is cheap in a high risk, high reward scenario, that doesn't mean it's like, well, there's a 70% chance that I'm gonna have a multi-bagger. In that case, we will all, we would all be rich as hell. No, the whole idea is like Snowline. How many failures did, if you bought Snowline at 60 cents, you're up 622%. That would have paid for 12 other similarly sized positions that got cut in half. You're down minus 50% on 12 other positions, and your portfolio would still pretty much be even. If only 11 of other similar sized positions went down 50%, you would be in the green. If you expect every single stock you own to do what Snowline has done, you're going to be disappointed. That's not going to happen. If you would be right on, I mean, in this case, if you know, 1 in 4 actually became, you know, pretty good success stories. I mean, Snowline isn't even, I don't think that this run is done. I mean, if I fast forward 1-2 years, I think it's going to be materially higher. So who knows? Maybe Snowline, if you just had a, you know, let's say a hodl approach, you let like my gambler portfolio, where you just let the winners run. Maybe this is going to pay for 20 or 30 stocks that got cut in half if you started with the same position size. That's what just grinds my gears. It's like, you know, the amount of crap that, let's say, Quinton gets, where it's like, you know, he's bullish on some high risk, high reward junior, and let's say it's trading for 10 million, which is basically not pricing in any success at all, and, you know, they don't find a world-class deposit, which is going to be rare. It's like, oh, you know, he's so crap at picking stocks, or oh, whatever. It's like, that doesn't make any sense at all, because if you start at 10 million, and if it were to become a world-class discovery, that would obviously, you know, 20, 30, 40, 50 bagger or something. it would pay for an enormous amount of failures in that case. That's the thing. It's like what is priced in? What is priced in? The big problem is obviously that most people don't have the patience to sit on their ass, even in good stories. It's like, how many do you think actually made 10 to 20 bags on Great Bear? I've talked to people who own Great Bear. Almost everyone sold too early. So even in a success, it's very hard to capture all of that. And you would need to suffer through, same with Great Bear, massive corrections along the way. This is a 45 back to the same price point, down 47 again. And I mean, this here was, what was this? 40%. I mean, every single drop here is like, how many people get shaken out along the way? A bunch of people. So even if you find one of these, most people misplay them. There is no way to have a success story pay for 10, 20 other failures if you give the said success story 2 months of runtime. No, this was, as you can see, a gradual climb. The longer you sat in Snowline, the end of the day, the more you made. But on a month-to-month or even month-to-6-month basis, obviously you could look very stupid and very wrong. To February, yeah, 6 months. 50% correction over 6 months. How smart do you think people felt when they sat in Snowline from this point here? But if, let's say they bought here, almost back to no gains over this period, that's gotta, feel bad. But give it more time, let the market correct, because this might be overshooting and this would be undershooting. All of a sudden you're at least up 132%. And again, the more time you give Snowline, even though it might go something like this, I think Snowline is going to be trading higher a year from now and 2 years from now, etc., etc. And obviously, the cheaper you bought, the more money you're going to make. Trigon Metals, combat mine progress. You can read this news release yourself. I'm not a mining engineer, so it's not. I don't understand everything that is in here. But it sounds like things are progressing, and I would say, I mean, it's soon expected to be a copper producer, and here you got a upsized placement. That's a good sign. You had some really good hits from the combat mine. East Pit delineates 9 meters of 7.9% Cu and 23.8 grams per ton Ag. Obviously that's a highlight hole and it's just one hole, but it's like, yeah, okay, obviously you would make money on that kind of mineralization. They increased the land position, this was back in June, but also Trigon granted permits to highly prospective high-grade silver-lead ground in Morocco. We know they have the Silver Hill property and they are expanding their footprint in Morocco, and we know Aya or Maya, whatever they're called now, are doing wonders, have been doing wonders, mining silver in Morocco. It's actually the highest ranked jurisdiction in Africa, if I'm not mistaken. Who knows what's here? But I like the fact that it's like when everything is cheap and there's little competition out there, pick up as much good ground as you possibly can. I want to own an empire because I'm front running the times. Like, no, the junior sector investors can ignore reality, meaning that the supply and demand picture for, well, especially silver, copper, and a bunch of metals is getting increasingly favorable. That should obviously be priced in, that there's not enough supply expected in the future to meet demand, so we expect higher prices, and that's probably why the majors are buying up operating assets right now, especially in copper, because they believe that a rise in copper prices probably just around the corner. If you thought the rise in copper prices was, I don't know, 10 years from now, you might, put more money on not operating mines, because in that case, you might risk bankruptcy in the short term. Unless they're really good mines. No, I think they're buying the operating mines because they believe that, the acquisition is going to look cheap sooner rather than later. But I like these juniors. That same with Pacific Ridge. I mean, they amassed a 5 project portfolio copper gold assets. Because when the commodities, because I think I saw a chart said the commodities were cheapest they've been in, I don't know, a long time at least. I want to own it. I want to be able to buy all of that real estate, commodity real estate, when it's cheap, and front run the revaluation. Especially if it's like in the West, where we're talking about ensuring, critical supply of these metals. If I bought it in China, whatever, or Indonesia, East probably has a better, supply security, because like China controls so much of many of the minerals and metals. But if we think that the demand supply is looking favorable on a global basis, and especially from a Western security of supply basis, that to have these assets in the jurisdictions where they're going to put an emphasis on getting them into production, where they might get cut off from the East. So even from a global basis, yes, we need more copper, whatever, but then maybe East, or basically East. The East bloc says, well, we're not going to export to the West, like they did with germanium recently. I think China, hampered the exporting of that. Obviously the value obviously the value of germanium in the West, which doesn't maybe right now have a good supply of it, might go exponential. So I'm front running that as well. Right place and right time. I mean, that's how you could, just add on a bunch of revaluation aspects. CDN Maverick, they have mobilized for phase 1 reconnaissance at Ponchville lithium prospects. A very new company, underfollowed company. It's like the share structure is very tight. I own quite a bit of this. I truly see it as one of those, I wouldn't say extreme risk, but extreme potential scenarios, because it's very cheap. 8.8 million. They got some cash, and they own shares of Norum Lithium, I think, and they have a deal with what's the company called? I can't find, but they sold some lithium properties in Argentina, I think, and they got shares through that. So I don't know, actually the enterprise value, I think actually their Norum shares might be worth 1-2 million or something, and then they have more shares in that the company that's earning into their lithium projects in Argentina. So it's like it's just absolutely super cheap. They recently picked up ground near I think this is Frontier Lithium, and they picked up this ground. And their Ponchville lithium prospects is in Quebec. Well, I guess this might be in Quebec as well. So they have. No, this is not it. Okay, they don't have any maps here. Anyway, so the idea behind this one is like you see what happens with some lithium juniors if they find pegmatites, etc. I mean, Ophir Gold, for example, they've done well by finding some pegmatites I think one could say it's on the trend of well, is it on trend of Patriot Battery Metals? I'm not sure, but the VP of Patriot Battery Metals is on board with Headwater Gold. Anyway, this is one. It's like, hey, this could become a 10-20 plus bagger. Well, maybe more than that if they find something substantial, obviously. But it's high risk. They have some of the highest lithium lake sediment anomalies in all of Quebec. And if that's just a lot of smoke and they don't find a good source, hey, then maybe I'll lose money on Maverick. If all that smoke is explained by a good source, maybe I'll make a bunch of money on Maverick. Again, the shotgun approach, high risk, high reward shotgun approach. If one does well, you buy it cheap. If it does well, you hold it long enough, maybe it's going to pay for 10, 20 other stores. Then we have Inflection Resources. AngloGold has initiated 35,000 mid-reel program across portfolio copper gold projects. One of my personal favorites from a high risk, high reward perspective, 25 million. And just to make it, a simple way to look at it, in my opinion, is that, okay, this is the stretch of land that Inflection has. It's picked up all the, what it thinks is prospective, all the prospective ground undercover, the extension of these volcanic belts here, the Juni, Narromine and Molong volcanic belts. Okay, these are the shaded in, well, black. So you can see from this point here, down here to here, there's Tomingli, North Parks and Cowell. I think both North Parks and Cowell are probably worth a few billion each. I don't know what Tomingli is worth. Anyway, this belt here, you have the Cadia deposit complex. I think when I read a Credit Suisse report from 2017, which put a dollar value on Cadia at $8 billion Australian. And you got Boda. I don't know what Boda is worth actually, but it's pretty good discovery. So if you just combine the strike length of the exposed volcanic belts, you add these two together, then you have three major mines, $8 billion here, probably, let's say 2 billion and 2 billion here. So that's 12 billion plus Tomingli. I don't know what Tomingli is worth, maybe 1 billion. I'm just, making numbers up here, and maybe, I don't know, 250 million. So that's, let's say, 13 billion in value found, and five, four, one massive, three significant, and one good sized deposit with this kind of exposed strike length. That's basically a bit less, I think, than what the ground that Inflection has. So, from a balance of probabilities, the only thing that is different, as far as I know, between this ground here and the ground here is that this has sedimentary cover. So the same geology is expected to continue over this stretch of land. So in that case, there should be a few or more significant copper gold porphyries hiding under here. But it's just that's why they were able to stake it. It's just covered with sand and nobody has bothered to be looking for them. But it makes absolutely no sense that where you have this geology outcropping, and all of a sudden it stops. Nothing, no additional deposit formed under here. Why? No, it doesn't make any sense. It's just that it's covered up by overburden today. Back in the day, there was obviously no overburden. It was just a continuous stretch of land with probably, saw the same events happening, geological events happening. So I think it's, if you just put it really simply, there should be, just based on the balance of probabilities, there should be a few billion-dollar deposits hiding here. The trick is, of course, that yes, there is more overburden here. So it's like there might be a coal hiding here, but maybe it's too deep. That is, I guess, a risk. But Cadia, that's today mostly, I think, a block caving operation. I'm not sure if Norparks, I think they have open pit mines as well. I think all three have, but they have block caving components. And obviously the big mining companies are getting better and better at block caving. So I don't think that's really going to be a problem, because you can block cave to, 1 kilometer. I think that's certainly feasible. So, or let's put it like this. There should be one or more billion-dollar deposits within Inflection's ground, just based on this on the strike length they own. And this is how many targets they have. And they're only after big targets. That's the thing. There might be smaller porphyry targets, whatever. They have actively, and they're run by I think the most impressive technical team I've ever seen in a junior. A bunch of ex-BHP people, and Western Mining and stuff. Douglas Haynes is the let's say leader of the technical team. He found the Olympic Dam, which is I think the largest mine in Australia, and Yundam and Kamoa, etc. So you can probably not find a better technical team. So balance of probabilities suggest over this kind of strike, given what they found where it outcrops, there should be at least a few significant billion-dollar copper gold porphyry deposits on Inflection's ground. And these are the areas where, according to the geophysics, where they believe they might be. And Duck Creek is here. It's there where they've hit bornite. So imagine again, it's like, imagine what Inflection, excuse me, imagine what Inflection might look like after 35,000 meters of drilling and testing. I think they said they're gonna test 24 principal target areas. 24 principal targets. We know there should be significant copper gold porphyries here, more than one. So how can the view of Inflection differ 18 months from now with 35,000 meters drilled from today? Obviously it could differ a lot. They could have made a significant discovery. It might be a Duck Creek. But they would kinda need to miss on everything for Inflection not to look cheap today. And if they hit, given the market cap today, one hit could easily make this a multi-bagger. If they find something worth 1 billion, that's 250 million. So that's a 10-bagger from here. One 1 billion deposit. That's a 10-bagger. That would pay for 20 other, let's say, stores that went to down 50%, or 10 that you lost everything on. If they find more, you can obviously multiply that. If they find Acadia, well, then, well, that would obviously just be absolutely massive, because Acadia today, it's operating though, of course, and it had open pits, but I actually don't know if they are actually mining open pits in 2017. Anyway, their block caving operation is printing money, and it was that complex was valued at $8 billion. Imagine if you had 25% of 8 billion starting from 25 million. Half Acadia, absurd success. 1/4 of Acadia, absurd success. 1 Acadia and a Koval, absurd success times 2. So again, I don't know that Inflection is going to hit or find one or more significant copper deposit in this real program, but I know that there should be a few hiding here. And if they're going to test 24 targets, Inflection might look completely different in 18 months. For the better, obviously, because it's not pricing in much now. But also on that note, how do you play a story like this? I thought I was going to do a segment of its own for that, really, or I might do that actually. Still, let's just touch on it. How do you play this kind of shotgun approach story? If you buy Inflection, wait for one drill campaign or one target to be drilled. Let's say they miss, it goes down 20%, and you sell out. What's the case here? The case is that after, in my opinion, balance of probability suggests there should be one or more significant copper gold porphyries hiding here. But you don't know which one. And majority of these targets should be duds. The best possible way, in my opinion, to play a case like Inflection, there's, well, two ways. Either you play the let's say, quote, safe drill hype speculation, meaning that you ride the drill hype going into every single target. If you can actually, if you're even able to manage that. I don't think you're able to manage that, because I don't think, that would be almost impossible in a sense, because you don't know when we will get drill hype and when we won't. So let's say you assets are coming up for a particular target and the price is down 10%, but you sell because you don't want to take the asset risk. Well, you lost 10%. You turned a paper loss into a permanent loss. You sold 10% with a 10% loss. But maybe, on average, you're going to get a 20% drill hype going into every target. I don't expect to, but let's say you do that. Yes, you'll take some losses, you'll take some gains, and maybe on average you'll make 15% on your money. But that's a lot of activity, and you have to keep up to date. It's like, okay, when do we expect assays? You have to be ready to sell going into drill hype every time. But the other hodl way to go about it is obviously that you kind of nail yourself to the share and say, okay, I'm gonna pay 25 million, let's say, for all these targets, and I'm gonna let the 35,000 meter drill program play out, because then it's gonna be binary. You're probably either going to be down or even. Well, let's say you be down 50%. So the risk is 50%, let's say, because they have some more targets, and I know these guys are working all the time in trying to make up new targets. So I don't think even this land package here and the Caron Gold project, I don't think that's enough. They have 30% of their money invested here. I think they have even bigger plans. But let's say worst case scenario, 50% permanent loss. The other side of the coin is that they will have hit something at least one target, and you might make let's say a significant discovery, and you made a bunch of money. That is obviously, in my opinion, easier way to go about it, to just a fire and forget type scenario, where it's like, okay, I'm buying in here and then I'm pretending I go in cryo sleep for 18 months. Either this story is gonna be a success and it's gonna be up multiples and pay for a bunch of other stuff, or it's gonna be a minus 50% position. But it makes absolutely no sense, in my opinion, to buy into Inflection for one target, because any single target might have a low chance of success. Let's say even Duck Creek has only a 10% chance of being something significant. It might be higher than that, but it's like when I calculated the value, and I didn't even, I think, use 24 targets, but I used like a 5% chance of success for Duck Creek, for example, which I think is low. I came out with a risk-adjusted value for Inflection right now at like 140 million Australian or Canadian. Obviously, that's multiples higher than it is today, just based on the cumulative risk-adjusted value for each target. So again, if you buy this and it's like the case is not, and that's, I mean, obviously management understand this, that it's a numbers game. But if you buy Inflection, you pay 25 and you only stay for 5 holds from one target, let's say. You only stay for Duck Creek. That's not playing the odds. No, you have a chance now at 25 million to play 35,000 meters of drilling over 18 months. And any single target here might have a low chance of success. But even if the chance of success is 5% or less, when you stack them up and you come out with a probability, it's like, okay, let's say there's 95% chance of failure. What are the chances that they're going to fail 24 times in a row, even if they have a 5% chance of success? That's 0.95 to the power of 24. Actually, I should have, 1 second. 0.95. How do you see? 1 second. That's that would, if a 5% chance of success per target would be true, then the chance of them finding something significant and making a multi-bagger or producing a multi-bag would be 71%. So all of a sudden, if you played out let all the targets play out, let's say the chance of failure is only 29%. So actually it's more than 50% chance of a multi-bagger, which, I mean, sounds about right in my opinion, given this slide and the people involved. But so let's say you hodl through the entire campaign, and if we put a 5% chance of success per target, there's a 71% chance you will have a multi-bagger at the end of the day. Okay, but if you bought Inflection today and stayed for one target, that's a 95% chance of failure. That's like, I was going to say, that's like putting money on fire. Anyway, I hope you get what I understand. But most people will play this completely wrong. Same case, everybody has the same opportunities, but you know the case doesn't add up. It doesn't add up to, again, these, because they haven't made a discovery yet. And I don't particularly like pre-discovery plays, but when you have 24 targets, that increases the chance of success greatly, obviously. Most companies have one target. Maybe there's a 5% chance of success there. But people tend to like, oh, this is a pre-discovery play and I own another company that is a pre-discovery play. They have one copper gold target. And they think they are even slightly similar. No, they're not. This is like 24 one target juniors in one company. So in my opinion, Inflection Resources is one of the best high risk, high reward stories out there, because if you actually stack up the amount of targets, I would say it's possibly low risk actually, with high risk, high reward potential. But that's just me. Headwater commences drilling on its 100% owned KD Gold project. And you look here at the latest news releases. Headwater, yeah, this is the latest one, drilling on its 100% owned KD Gold project. That's where they've had the best drill results to date, with 6.34 grams over 14.55 meters, including 30 grams. I mean, that's 1 ounce per ton over almost 2 meters. Headwater commenced drilling at Spring Peak project. I think, if I remember correctly, this is a multi-rig exercise. And the news before that, Mahogany project. And they will drill Midas North. And I think they're up to... Cade is one of 3 currently active drill programs in the Headwater portfolio, with 5 drill rigs now deployed in Western USA. Headwater has a market cap of 20 million. And they're chasing targets that could work in almost any gold price environment. They're chasing high grade, low sulfidation epithermal systems in the US, primarily in Nevada. Also one of those. Like, they have, I think, 11 projects. It's like, if Newcrest is involved, they believe they have Newcrest potential in those targets they're involved with, obviously, and they have 4 of them. And they already have discoveries at Spring Peak, discovery holes at Spring Peak and Katy. It's like, I think this is one of those things that people totally miss. They just look at it, it's like, well, they have, early stage exploration success. Well, I can find companies with that. Yeah, but they have many kicks at the can. They only need 1 to succeed. If Spring Peak is a success, we should have a multi-bagger on Headwater. If Kate is a success, we should have a multi-bagger on Headwater. If Midas North is a success, that should be a multi-bagger. If Mahogany is a success, same story there. And the 2 other earning projects. Well, I think Mahogany is an earning project with Newcrest. That's just, again, it's like... Honestly, it's like, if I had a small portfolio or a smaller portfolio and could actually buy in bulk, it's like I would probably have no problem having 10 to 20% of my small portfolio in Headwater and Inflection Resources, for example, because they're so internally diversified. Yes, at surface there are... Well, in the case of Inflection, it's a pre-discovery play. In Headwater's case, they actually have discovery holes. But if you combine them, Inflection has 24 principal targets. Headwater has 11 projects. And if one succeeds, it should pay for the other. So you have, 11 plus 24. So you have 35 kicks at the can, and some are already discoveries. It doesn't make sense. Balance of probabilities would suggest that at least 1 out of those 35 targets / projects should be a success. And if they are a success, the company that has it should multi-bag and pay for the other ones. That's how I think about it, at least. Western Alaska Minerals reports first assays from 22 drilling. 19 meters of... I thought they calculated the... Well, they don't even calculate the AU equivalent. Anyway, when I was on the site visit, I spoke to another shareholder of Western Alaska. He's very bullish on Western Alaska. I'm very bullish on Western Alaska. If they hit on the last hurrah target, hopefully they find extension this year. I mean, the one I spoke to, he believes they have 100 million ounces AG equivalent already from what they've already kind of drilled. That's more than I thought. That would put it in the probably in the development worthy stage already. And it's just obscene when you think about how much land they have left to explore just within the Water Pump Creek district. And they have another project with a porphyrin CRD potential. Now, Western Alaska is one of the HODL stories. I think this is an absolute no-brainer. And given the price, it's not pricing in a good high-grade CRD mine. So that's also, it's like if this could be, in my opinion, a multi-billion-dollar system. And I think the market cap is around 130 million or something. 120. So again, if this becomes a success, well, I mean, it looks increasingly probable that it will. But if this becomes a legit, world-class mine, that's going to be a 5-10 bagger easily, I think. Maybe more than that. And it's going to pay for a bunch of other ones. So at same position size for all companies I mentioned so far, any of these have potential to pay for the other ones. Then we have Goliath, visible gold found on surface at Full House near shorebed and newly discovered shear zone assaying 113 grams per ton gold and 249 grams per ton silver. New drill target for 2023. So just look at some of the slides here. Here you have the shorebed zone. Here you have the Bonanza shear. I would think this is a company maker in itself, this area. But this is some of the stuff they have to work with as well. Here's a more closed in or zoomed in. Here they're finding some high-grade silver, high-grade gold, Bonanza-grade gold, high-grade silver, lead. And here you have the shear zones mapped out. This might be kind of a district play at the end of the day. And they have a huge land package. And the market cap is 70 million. So again, it's like just to recap, it's like we know what Inflection is priced at right now. It might be priced completely different in 18 months. We know the amount of targets that Goliath has. This is, right now this is early stage potential. This is probable potential. $70 million for Goliath might look increasingly cheap in hindsight after this field season. Maybe especially after the field season after that, even more so after the field season after that. These will not become multi-baggers just like that. We need news releases, maybe over multiple seasons for that to happen. But if any of these prove up their potential, with 20 news releases, let's say, over the next 1-2 years, then they will pay for all the rest. If 2 out of 6 work out, you'll make a lot of money. But it's not going to happen tomorrow. We need some answers. They need to ask questions and we need to get positive answers. But the questions cannot be asked tomorrow. The questions will be asked continuously over 1, 2, 3 field seasons. And we will get answers over 1, 2, 3 field seasons. Just like Snowline had to ask a lot of questions, geological questions, over 1-2 years and got favorable responses, and then it allowed it to become a multi-bagger because value was increasing as they were asking questions and got positive responses. Then it paid for a bunch of other ones. But in the short time frame, Snowline might go down 50%. Any of these companies might go up 50%, up or down 50%. But the big picture is the more questions that get asked and get positive answers, the bigger it's going to become. So when Snowland continues to ask questions over the next, well, this field season, next field season, maybe they make a discovery this field season. Okay, good positive answer. Maybe the price will end up here or whatever. Maybe they ask more questions, or maybe they find something at Gracie, maybe they find something at Tosh and Cliff, maybe they find something at the other like 30 reduced intrusion targets they have. Maybe they keep growing for years and years and years, and at the end of the day, you know, if you bought here, Snowland will have paid for 30 positions that got cut in half. But every single one, expecting every single one to be a mind-blowing success, that is greedy, and that's not even required. My personal goal is 50% per year, but that might look like down 50%, up 200%, etc., etc. Down 50%, up 200%, down 50%, up 200%, yada yada yada. In the short term, I have absolutely no idea where any of these juniors are going to trade. I just know that's why I, again, aim big, miss big. If I think one could have a value range of somewhere between here, it doesn't really matter that big if it will be here or here, because from, you know, today's price it should still be in the green. But every single company I own right now, the case is that it will look cheap today, a year or 2 years from now. Pretty much that. Or in the case of Condor, maybe it's going to look cheap within 6 months. Maybe very cheap within 6 months. So that's the thing. It's like your portfolio should always have the best yet in store. So in 2 years, we might not own the exact same companies, because in 2 years, maybe the success stories we own, maybe they will almost be quite mature. And we'll roll that money into a company that was where these companies were 2 years ago, with the best still ahead, with the quantum leap potential over the next 2 years. So always, in my opinion, the portfolio today should always be undervalued relative to the future we see 1-2 years from now. Just continually reshuffle, so the best is yet to come. So in that case, our portfolio should always be frustratingly undervalued based on what we think. That's the thing. It's like people complain about their juniors being cheap right now, but that is the whole point of it. They should be cheap right now based on the future. If you're happy with the performance and everything you own is fully valued right now and you have nothing to be frustrated about, then the future is bleak because there's no upside left. You should be frustrated about how cheap your portfolio is. That's a good thing. But people tend to only celebrate when their companies are revaluing every single day. It's like, oh, you know, I'm happy now because my company has gone up 100-200% in the last 6 months or whatever. And it's like, and okay, maybe it's fully priced, and it's like you have nothing to well, you should take the bank the profit, because otherwise the future is getting worse and worse because it's almost fully priced. I think my portfolio is absolutely dirt cheap. That's how it's supposed to be. Lastly, line 1, metals robust gold grades from Tuvata mine. I think I did a video, what was it, a week ago, maybe 1.5 weeks ago, where I talked about, I've talked to people who believes that given how this alkaline gold system works with veins going all over the place, that when you drill it, you'll probably miss a few veins, etc. Because it's going to be hard to, let's say, one vein branches out in a different direction, like, I don't know, on a micro scale, like a branch of a tree. You're not going to hit every branch when you drill. So, okay, what's the conclusion here from, well, first of all, look at the phase sampling results. I mean, these are the highlighted ones, but they're like, 50 to 300% higher than than the last resource grade, I think. And here we have Walter Berkoff. We are very pleased with the result from our phase sampling program, blah, blah, blah. They provide the most accurate representation of the grade of the material that we're mining, and these results to date are much greater than expected. Lo and behold, it seems that Tuvalu, and this isn't even the 500 zone, it looks like Tuvalu, when in operation, will have higher grades than what the drilling shows. That's obviously a absolutely superb thing, because then it means that this might actually surprise to the upside. Tuvalu is once again outperformed, and as an underground development progress, we're beginning to see the true potential of the system. So imagine if, one thought that, hey, the grade is going to be 8-9 grams per ton, which is very, very high, obviously, but it's like, maybe it's like production grade is like 12 grams per ton. Maybe that's going to double the margin. It's like, might have huge implications for the value of the Tuvalu mine. And obviously we're not into the 500 zone. These are all from URV1. 500 zone is like thick as hell, and I don't remember. Some of the holes, I think, is like 50 meters of 19 grams or something. That should be a cash cow, obviously. And if the same thing persists, that is like the drilling is actually underplaying that true grade as well. You can imagine the kind of cash flow from that. So again, it's like, I think all of these companies have the big payoff is from now until 1-2 years ahead. So if they work out, the very best is yet to happen. That's the thing. Investing is all about the future. All about the future. Your portfolio should be frustratingly undervalued at any given time. Otherwise, you probably overpaid for your holdings. And if, I don't know how many companies I've gone through, but it's like, again, I know Snowline is paid for a bunch of cases that did not work out. But that's the thing, especially with this more high risk, high reward place. If 1 in 5 works out and you hold it long enough, that's going to more than pay for the other 4. So I think every single one of these stocks have multi-bagger potential over the next 1-2 years. And if 2 out of the 6-7 work out well, they're going to pay for the other stores. But the key again is that you're not going to have a multi-bagger that pays for the other ones unless you let them time to play out. From this period here to here, Snowline didn't pay for shit. It went down 50%. From this period to here, it paid for multiple portfolios getting cut in half. Not multiple portfolios, multiple positions. Anyway, so long rant, but I hope, again, okay, if there's some I think the most valuable insight I can leave you with is that if you are frustrated with how cheap your stocks are, how undervalued they are, that is a sign that you're doing something right. That is a sign that you are investing for the future. That is a sign that the best is yet to come. And that should be your biggest problem at all times. How frustratingly cheap your portfolio, your holdings are. If you constantly, sometime they have to revalue actually, but it's like, that is not a bad sign, that's a good sign. That means, yes, you know what investing is. Investing is not looking hindsight and see, I should have bought that, and talk about opportunity cost like it's a period of time, which it is not. If you only have what you think are no-brainer cheap stock holdings right now, that means that S&P 500 probably has a huge opportunity cost for you right now. regardless of what the S&P actually does over the next month or two relative to your portfolio. So that's a good sign. You should have an undervalued portfolio at all times, because that means the best is yet to come and the risks are to the upside. So think about that. That means the best is yet in store. And given that we're at a bear market levels, that's how it's supposed to be. And again, absolutely nothing lasts forever. If you were absolutely disgustingly frustrated how cheap your holdings were here, absolute great sign, because then you made many times your money over the next few years. Same here, same here, same here, same here, same here, same here, etc., etc. Okay, thanks for listening. And yeah, so again, well, lastly, it's like that's why I'm gonna try to actually travel more, because I know there's nothing else to do than to wait. If we own cheap holdings, if we own significantly undervalued companies, our job is already done. The only thing left to do is to wait for them to not be this undervalued anymore. So you might as well do stuff that you enjoy while waiting, because even the quickest rallies takes 8 months. We're not going to get to a sell position in the junior sector in a day or in a week or in a month or in 2 months. 8 months might be as quick as they come, basically. That's still 8 months. You can do a lot of things in 8 months. You can get in shape, you can travel, you can read X amount of books, you can become proficient at whatever. So there's a lot of stuff to do while we wait. And yeah, so this is not investing advice. I think almost all the companies I mentioned right now are holdings. Well, all are holdings of mine, but many are sponsors as well. So consider me biased. I cannot guarantee the accuracy of the information I've stated. This is just my personal biased opinions. Do your own due diligence. I'm not an investing advisor, etc., etc. I don't share your profits or your losses. Yeah, do your own due diligence. Take care. Bye.